Hey guys, what's up and welcome. In today's video, we're going to be taking a look at Tom Lee. We've got two videos over the FAANG stocks. If you don't know what those are, that's Facebook, also known as Meta, Amazon, Apple, Netflix, and Google. So he's going to be giving his opinions on why the fundamentals are not weaker. If you guys enjoy these videos, smash that like button for me. Let's jump into them.
I mean, this has been a victory for those who've been bearish. But to me, this is also a reminder that the stock market and investor views about equities really depends on FAANG. You know, FAANG didn't do well this week in earnings, and it really sort of...
Wait a second, Tom Lee. FAANG did pretty good in earnings. We've got Meta that did pretty good, only down 5%, but had great earnings report. We had Amazon have great earnings report and jumped. We haven't had Apple yet. Netflix had a great earnings report and jumped. And we had Alphabet have a great earnings report, but it dropped 10%. So I'm not sure what he means. Those were all pretty solid. The stock prices did different things, but they were all great earnings reports.
Took some of the support out of stocks. Do I think the FAANG thesis is changed or broken? I mean, I don't think so. To me, if someone hasn't owned FAANG all year, this is a chance to get in.
But the thesis can be intact, right? That these are the places you want to be.
This is the chance to get in, FAANG. I'm glad he said that, guys, because on this dip, I've bought so far some Amazon and some Google.
Have that while still saying, you know what, the stocks got too stretched and their valuations got too rich, and now it's time for a pullback.
Yes. I mean, you know, we're down 10% from the highs for the S&P, so I think a lot of bad news is baked in, but we've also done, as you point out, a lot of technical damage, and people don't like the 10-year at 5%. I mean, this is why next week is pretty critical, because we do get some pretty important data points.
I mean, momentum's a dangerous thing at times, right? I mean, you can say, well, it can carry you when the times are good for these FAANG names, and that was one of the criticisms the whole time. It's 7 stocks, and 493 stink, and then now it's 493 still stink, and the 7 look dicey. That's a problem.
It is. I think there is some good news. You know, I think this week there has been some improvement in the internals of the other 493. We did a report even last night about how the small caps are starting to look a little stronger. So I think the 493 is less bad. And in terms of returning capital and compounding capital, the FAANG story is strong. So you're right. I don't know if the market's comfortable with the multiple now, but in 12 months, I think they're great opportunities.
Is this a cautionary tip?
Guys, the FAANG stocks have been strong and will continue to be strong. That's why there's an acronym about them. They beat the market, they consistently beat it. They're almost monopolistic. Some of them are monopolies. And they're just some of the best stocks you can put your money in. Even in downturns, even in corrections, guys. Where else would you rather put your money? A lot of money goes into the stock market and a lot of money stays in the stock market. A lot of people and a lot of big money are investing constantly. So their money has to go somewhere. And what's going to do the best when it comes to falling? The FAANG stocks, because you're going to get the best companies at a great price. They might fall a little bit more than the indices, but they're going to come back faster and they're going to grow faster. What happens when we're in a great bull market? The FAANG stocks are still where you want to be, guys, because every day you're adding money, you're getting better and better prices. And when this thing turns around to get that rip your face off rally, you are going to be positioned great for the long run.
Tale about where earnings expectations have gone. That's been the big debate. Now we're out of the earnings recession. We start to get liftoff, and then we get higher and higher as you turn the calendar into next year. Do we need to rethink where we are because we're worried about the economy? Rates are high and may remain such.
Yeah, I've got a contrarian take on earnings. Number one, if you look at the stock market reaction of those that beat, they're up 0.5%. That's better than Q1 and Q2 of this year. So actually, we're getting better reactions. It's just like you said, it's more in the 493, not the FAANGs.
Which is good. We need some broadening out in the market. We don't want just the 7 to do good.
The PMIs have turned up year over year, and historically that leads to earnings growth year over year, so it's confirming that earnings should strengthen from here. And if we look at even Q3 earnings, you know, they've actually gone up 2% since the start of reporting season. So I think the FAANG's disappointed in terms of market reaction, but the rest of the market's actually been okay, and I think that is what's going to help us get through the rest of this year.
I just wonder if there's a counterintuitive way to look at that. So PMI is good for earnings. However, the Fed doesn't necessarily want all this to be good, right? They want demand in some respects to start to slow down, and they've been unsuccessful in getting it to do that. So as they potentially step up their efforts to make demand slow down, that potentially hits earnings, doesn't it?
You're right. I think there is a view that the Fed is running out of patience. They're like, look, when are we going to break the economy?
In my opinion, this last week or two, all these analysts have switched to bearish, and they're trying to get the best prices they can because we're going to have a rip-your-face-off rally for the end of the year. We've got Jeremy Siegel calling for an end-of-the-year rally. We've got Tom Lee, the permabull, the great caller Tom Lee, saying it's time now to get into the FAANG stocks. We've just had earnings. We're going to have 3 months of, no new information as far as stock-by-stock information. We've already got the Middle East problems. We've already got the Fed problems, the money problems. Everything is already out there and nothing's really new. I think if we do have a recession, definitely not in 2023, maybe not even in 2024. It seems like the time to be putting money to work, and once we start getting closer and closer to the Fed lags catching up and maybe the recession coming around the corner and we start to see the stocks peaking out, then maybe you can make a different decision, but I don't think we're there yet.
But I think maybe the more subtle point is I think the Fed would like to see the labor market slow down, because we know underlying the two big drivers of inflation are housing and autos. They've slowed, but the job market's still strong. Next week is the jobs report. If it's a little soft, I think that takes the edge off. And of course, next week we get the FOMC meeting. And again, I think that they're going to be patient because a lot of tightening, especially 5% 10-year, is already going through this pipeline. So I think the Fed can actually be patient.
Sure, but no. Now, I agree with you that the backup in rates has given them the flexibility to be patient. It suggests that, well, the move in rates has done some of the work for us. However, if the labor market starts to show softening, then we have to worry about what's been the whole key to this thing to begin with, and that's the consumer remaining.
Guys, if the labor market starts to falter, we are going to start to crumble at a crazy rate, because they lose their job, they lose their spending appetite, they lose the money to be able to spend, businesses' earnings contract, stocks have to fall. All of this keeps getting worse, or we're still at high rates. The high rates are eating them. Everything's just going to be getting hurt from every end, and there's not going to be anything to ease the pain. What we have right now easing the pain is a strong consumer. Everybody's employed, and even though times are kind of tough and prices are high, everything is still getting bought because there's a lot of money. Once there's a lot of people not making a lot of money to spend, it happens pretty quick.
Strong. Job losses pick up, spending goes down. The soft landing story starts to unravel, doesn't it?
It's a delicate balance because, you really want to see jobs at 100,000 a month, and you want to see wage expectations cool off. So it's a tricky calculus, but I think that we don't have to reflexively say, hey, if the job market slows down, we're headed for a hard landing. That might be the market's reaction, but then that ends up being an overreaction.
You're still a Bitcoin bull?
Yes.
I want to end our conversation on that because I think it's the best performing asset class.
Before they get into Bitcoin, he said any other type of big reaction for these mega caps, guys, is he thinks, in his opinion, will be an overreaction. That's even a better time to put money to work.
The year.
Yeah.
Certainly one of them. It's up more than 100%. So what's your view of it here? And why has it been going up the way it has been recently?
Well, there's a couple things. One is it's been real buying. So there's real money institutional buying. We can see it in the CME volumes at all-time highs. And we know Asia has been buying again, and they've been absent. So this is true people wanting to get in. It's been a good sound money story, especially as we worry about Washington.
ETF optimism too? Is that where you're going to go also?
Yeah, the ETF,
Sheesh, 103% year-to-date Bitcoin? My good golly.
think is far bigger than people realize because, again, supply is going to be only 12 million a day after the halving. ETF could be $100 million a day of demand.
All right, guys, that was Tom Lee breaking down why it's time to get into FAANG. Now he's going to break it down a little deeper and jump into the fundamentals. If you guys are enjoying the video, hit that like button for me. Let's go.
Fundstrat Global Advisors, Tom Lee. He joins us here at Post 9. So what is your level of conviction in your bull case for stocks into year end right now?
It's actually high. I know it's been a tough 3 months, a brutal October, but I think stocks are getting washed out now, and the effects of this jump in long-term rates is starting to bite, and I think we'll see it this week in the economic data. I think that's going to push sort of Fed to be patient, right? Because this jump in rates just in the past couple months is equal to 4 hikes. And that should get investors a little more constructive about how the Fed reacts to incoming data. So
In the last couple months, guys, the rates have already done about 4 hikes worth of work for the Fed. That's what everybody keeps referring to when they're saying the Treasury yields are doing the work for the Fed.
I think with positioning, the economy being okay but slowing, and if rates could stabilize or fall and the Fed turning slightly more dovish, I think it is a formula for a rally.
But what about the leadership in this market? Last week, I mean, it wasn't like the big mega cap tech earnings were awful, but the reactions were.
That's right. I think the mood of investors has turned cautious, so they faded decent earnings. I don't think FAANG's fundamentals are weaker. I mean, they're still at the center of this AI sort of secular story. So I think FAANG actually leads into year-end, and that also helps lift the S&P.
But is your view based on the idea that rates are going to start to come down, that it's not going to be higher for longer, and therefore perhaps that we aren't going to see a significant impact on earnings as a result of these higher rates over time?
Yes, to an extent. There was a great report by Goldman Sachs economists about what fair value is for the 10-year. They used 3 models, and they came up with like roughly 3.8%. So the 10-year at 5 is reflecting this uncertainty about inflation, how high the Fed has to be. If the data softens, we're going to start to see investors say, look, the Fed reaction function is if we got unemployment picking up and inflation weakening, they're going to cut. So I think we're seeing the peakish points in the rates right now.
Doesn't the market eventually...
That sounds pretty good, guys. That would mean maybe the bottoming in stocks, which we call him for that year-end rally he's talking about. We also have Jeremy Siegel, if I didn't already say, he's calling for a year-end rally. 2 big names giving their opinions again at a great time to buy.
eventually transition to bad news being bad news?
Yeah, I mean, that's a bad quadrant to be in. You know, if we're slowing, but it's consistent with soft landing, that's bad news is good news. But if it's a sudden slowdown in economic activity because we just ran out of gasoline, that's actually bad news is bad news. So I think right now it's open to interpretation, but to us it still feels like we're tracking for a soft landing.
The other interesting thing, Goldman Desk takes a look today at some of the dislocations we've had within earnings. Morgan Stanley, Google, Verizon, like top 5 biggest underperformances on a T1 basis, T+1 in several years. What do you think that's about?
I don't think it's inflated earnings expectations. I just think the mood of this market's gotten really cautious because of all the geopolitical tensions. I mean, I noticed this over the weekend. Almost every conversation with a friend or family or even a client talks about what's going on in the Middle East. I don't know if someone wants to be adding risk, even if they think the earnings were decent. So I think the mood is cautious. But of course, as you know, when positioning gets too bearish, that's when bad news becomes good news.
When everybody's cautious, guys, aka fearful, you want to be greedy. A great quote by the Warren Buffett.
To dig into that for a moment on the geopolitical risk, because you would have thought it might have been more of a bullish factor for bonds if people are feeling so negatively about risk, and the equity impact isn't clear to me, because war can be also very bullish and stimulative to certain industries in particular. So how do you think about all that?
Well, I think that's been a source of confusion, because I spoke to a couple of fixed income clients over the weekend, and they were saying that the bond market is acting like the war is a limited war. That's why you're not seeing a flight to bonds. But the stock market, I think, it's not trying to discount the defense spending issue. I think it's trying to discount, is this leading to a conflict that could become, much larger? And, in that case, people are just changing risk premia, and that's why I think stocks are being hit while bonds haven't been hit. So you're right. If it turns out that the war is a regional conflict, this is actually bullish for equities because stocks converge with bonds.
All right, guys, Mr. Tom Lee gave his great opinions. He's even saying if the conflict gets worse, that's going to be great for equities. We have equities down, kind of flushed out. That's another positive for equities. We have sentiment very, very fearful. That's another good positive to get into equities. And then we have these earnings. They just smashed earnings on some of these Magnificent 7, guys. So we're starting to get some good probabilities on our side for some long-term buys. And Tom Lee wrapped it all up pretty good for us, guys. If you enjoyed this video, hit that like button, and I'll catch you tomorrow. Peace.